All right, well, let's get started. This is, of course, the 10th session of Module 3. We've looked at the strategy in detail, and what we're going to look at tonight is three things, which is risk and how I approach risk when I'm trading the short-term strategy. We are going to look at my daily routine and how I organize myself during the trading day, and then we are going to look at journaling, which is a very essential element of your trading, and I think the most important area when it comes to improving your performance. Obviously, you're going to have a recording of this to lean on, but it might be worthwhile just grabbing a pen and paper to jot down some things, because I'm going to give you specific things that you can do to improve your performance and improve it drastically as well. Little exercises when it comes to journaling. So first off, let's start out with a discussion of risk. The first thing to realize is that risk is very much down to the individual. There isn't a footprint, if you like, of what you need to follow. Essentially, the more you risk, the more you're going to make, and the more you risk, the greater the chance of losing everything in a series of losing trades. And even if you don't lose everything, the psychological issues of large drawdown can be pretty horrendous. And it can make you do all kinds of things like second guessing yourself on trades, and it's not a situation that you want to be in. So you do have to try to control your drawdown, which you can control to an extent through risk. Let's start straight away then by thinking about basic risk in terms of how much I will risk on a specific trade idea. And for me in the Bund right now, I currently risk 0.5% per trade idea, and 2% in total is my day stop. So we have a per trade stop and we have a per day stop. The reason that I start so low on the risk is because of the fact that we trade with pretty tight stops, which means that the impact of potential slippage is greatly exacerbated. If you think about it, if you have a 50 tick stop and you get slipped 50 ticks beyond your stop, then you're going to have lost 2R in total, right? But if you have a 5 tick stop and you get slipped 50 ticks beyond it, then you're going to have lost 11R, and that can be detrimental if you've got any kind of serious risk on the table. So in my swing strategy, because my stops are wider, I'm working to a 2% per trade idea. But again, here on the short-term strategy, I'm working to 0.5%. Now, you might think, well, what's the chances of getting slipped 50 ticks? If you trade long enough, it will happen. I've seen large fat fingers in the Bund, where a lot of prop traders got absolutely killed. And outside of the Bund, we've seen sharp moves. In the ES, we saw the flash crash in 2010. We even saw that huge move, when the AP Newswire was hacked. We saw the SMB debacle in January 2015. We saw the flash crash in the pound dollar in October, to name just a few. All of these markets are prone to having these sudden sharp moves, and these are outlier events, but if you get caught in one, you can't really afford for it to be career over. So it can be pretty bad even at 0.5%, but it's going to be a whole lot better than if it's 2% per trade, that's for sure. So if we think about basic position sizing, if you've got, say, a 10k euro account, then 0.5% is 50 euros. So in this type of situation, if that's your account size, you're probably going to have to go up from 0.5% to probably 1% risk per trade. Give yourself a bit of flexibility. Risk 100 euros per trade. It's going to be a 1 lot with a 10 tick stop, or a 2 lot in a 5 tick stop situation. You can't position size perfectly, but I don't think you need to try to. I think that you just get as close as you can. I know there will be many of you that are trading 10k euro accounts and are trading way larger than 1 to 2 lots, but Again, risk is down to the individual. I can't tell you guys what to do. I know people that with 10k accounts trade 10 lots. A 10 tit loss and you're down fucking 10% of your account, which I think is absolutely crazy. But initially you're not going to be making a living trading a 1 or a 2 lot, but it's about growing slowly and it's about watching that risk. You want to be around for the long run, not trying to make as much as you can in as quick time as you can, although I know that many of you, that's what you're thinking. But in terms of calculating my risk, I do base this on the end of every day. So when a new day starts, I'll look at my account size and then work out what I'm going to risk, 0.5%, and again 2% for the day stop. I never ever go above risk, and I don't really need to add anything more to it than that. I know, again, some people that will have a day stop, they'll reach that day stop and they'll think, okay, just one more trade because it's a really good setup. Not something I've ever done. I've seen people lose their jobs for doing that, but when you're at home and you don't have a risk manager, you can get away with it. That's why you need incredibly good discipline. So we're talking about risk. Now let's talk about targets in terms of how much you should be looking to make on a given day. I don't use these targets. In prop, and I always say in prop because it's the background that I come from and I'm in prop at the moment, they do advocate doing this. They usually give you an amount to aim for. Now I don't like doing this because my feeling is that if it's a very good day, you should press your advantage. It does not make sense to me to stop. But that is because I find that good days tend to get better. And the reason I have a day stop is I find that bad days tend to get a whole lot worse. Whether it's because you mentally slip due to frustration that you're losing money, or you get the urge to make it back and you make mistakes, but that tends to be the way it goes. Bad days get worse, good days get better for me. It's quite rare to see a bad day turn into a good day, and at the same time it's quite rare for a good day to turn into a bad day. It obviously happens from time to time, but it's definitely on the rare side for me. So if I start off with 1 or 2 losers, often I don't even trade to my day stop. I just try and get out of the way, but we'll talk more about that in a minute. I really want to present to you guys in this webinar what I do and not so much what everybody else does. And I don't want to keep stopping every 2 minutes and go, some people say this and some people say that. But I would just add that just when it comes to targets and day stops, people are very divided, and I've worked with some very good traders that believe that you shouldn't have a day stop. Alright, one guy in particular that used to do quite well said you should take every single setup, and maybe if you're trading in mechanical strategy I could agree with that, but I just adamantly cannot agree with that, because I really do believe that some days you're not on form, the market's not conducive to what you're doing, and you can dig yourself into a deep fucking hole very quickly if you do not have a point at which you stop out. So I would always advocate having that day stop. But targets, again, no. I think you should press it when you're making money. And the other thing as well is I think that sometimes people let targets impact on the way they trade. I've known people, for example, to say, oh, well, I've got let's say, a 50 pip day target, and their position might be up 40 pips into a really big level, and they think to themselves, I should probably get out here, but I only need 10 more pips, to hit my day target, and I don't really want to take another trade because there might not be one, so I'll just hold it. And they're almost trading their target, not the market anymore. I don't think you want anything that encourages you to trade other than the chart in front of you, and unfortunately this is the way it goes when people are trading their P&L, which trading a target is, really. So the next question when it comes to risk that I get a lot is, do I scale back in losing periods or do I scale up in winning periods? First, let's look at scaling back in losing periods. I don't do it. In a losing period, when traders start to lose money, it just so happens that they get a number of losers that destabilizes them, like 4 or 5 losers. They cut their size in half, and then they start winning, and it takes them twice as long to get back to where they were. I'm surprised by how many educators out there advocate cutting your size during a losing streak. I know that psychologically it might help, but if you have a robust strategy that's time tested, I think it's one of the worst things you can do. And in prop, we actually saw this a lot when I was looking at what a lot of the grads were doing, they'd come in and they'd say, do a 5 lot in the Bund, and they'd lose 10 ticks and they're down €500, right? And because they're down €500, they're a bit destabilized. They think, shit, that's quite a lot to drop so quickly. So the next trade comes along and it's a setup that's the same probability in their opinion as the first trade, but they suddenly do a 2 lot. And then on their 2 lot, they get a 20 tick winner and they made €400. And at this point, they're fucking 10 ticks up on the day and €100 down. And you know, again, if you're constantly varying your size like that, it makes it really hard to work out what's going on. So I don't scale back in losing periods. I definitely don't scale up in winning periods because, again, the mean reversion. You know, people get winning trades, double up their risk, they end up undoing everything. I worked with a guy who had, when he first learnt from me, he think it was 10 or 11 winning trades in a row, and this nutter trebled his risk. And of course, you know what's going to happen next. It's sod's law that immediately you're going to get into drawdown. And he's writing to me and saying, wow, you know, I've completely lost confidence because a couple of trades later and I've undone everything that I made. And you know, again, if he just stayed where he was, he would have given back a little bit of profit, but it would have been nothing major. But we'll talk a little bit about size adjustment in a minute. So you might think, well, how do you grow as a trader then if you're not, you know, upping your risk? You're growing quite simply because as your account grows, 0.5% per trade idea becomes a larger monetary amount. So I'm never betting more, but the money that I'm making grows, and it works like that. So sort out your per trade risk, sort out your per day risk. This is part of your risk management protocol and you should know it. You also really want to know what to expect. It really helps you with your confidence. I posted this many times on Twitter. So what you do is, as you grow as a trader and you start to journal your trades, which we'll talk about a bit later, you're going to understand what your strike rate is. And as you understand what your strike rate is, you read across from left to right, and you can see the probabilities of getting a certain number of consecutive losing trades within a 50 trade period. The biggest number of losers I have had so far this year in the Bund is 5 in a row. Now, I want to talk to you a little bit about some of my metrics in Bund tonight, but I kind of want to preface this by saying that it really doesn't matter what my metrics are. Just because I've had 5 losers in a row doesn't mean you're going to get 5 losers in a row, because we're not going to be trading exactly the same. Number one, this is a discretionary strategy, and number two, you have way less experience than me at trading this specific strategy if you are trading it the way I've taught. So maybe the fact that I've had 5 in a row gives you a bit of idea, but you know, don't take heart from that and think, okay, so I won't get more than 5. My biggest drawdown in this entire year to date has been 8R, which is 4% at 1/2% risk. Now imagine if I was at 2% risk, I'd have been a 16% drawdown. I had a horrendous period this year and I've worked my way out of drawdown. So again, in percent terms, this is not a lot, but the period was nasty, and in the peak of that nasty period, I only won 4 trades in 20. Sometimes I get that question of, well, how do you cope with this? And the answer is you only cope with it via experience. The more stats you have, the less worried you get, because you look at things like this, and we'll talk again about this when it comes to the month-end trade in a bit, but you look at this and you say, okay, my strike rate over time is, let's say, 60%, if it's 60%, and you look across and you see, okay, I've almost got a 1 in 5 chance of 6 losers in a row. So it can happen. You plan for that, and you start thinking, if I get 6 losers in a row at 2% risk, that's going to be 12% of my account down. How's it going to feel? How much money is that going to be? And again, it could be worse than this. I mean, this is only a rough idea. Remember, the extent of your drawdown is not necessarily how many losers you get in a row. You could have 4 losers in a row, 1 winner, and then another 4 losers in a row, and your equity curve could be plummeting. By the way, there's a question that's just come up, which is this swing and short term or just bunds? This is just bund, okay, because this is a bund module. So everything I'm talking about tonight in terms of my metrics is just bund. Now, let's talk about strategy risk then. If at any point I experience a drawdown of 10R, which would be 5%, then I would stop trading for a week and conduct a full review. I have only had that once in 9 years of trading the swing strategy, and I've not had it on the short term at all. that I've had to do that. So you can imagine when I was 8R down how I was starting to feel, okay? But you don't know how far your drawdown's going to go or when you're going to get out of it, but already I'm planning. Like I say, it's something that's happened once in 9 years on the swing, and has never happened since I've been trading the bund, but I'm planning for it. So if I got that, I'd be asking myself, well, how many trades I took were good? If you look back at your trades and you say, well, I took loads of good trades and I've done my arse to the tune of 10R, then that's really, really worrying, because it means that your strategy's shit, quite frankly. You know, you shouldn't be getting in a 10R drawdown if your strategy's any good. I mean, it could be a difficult period, and I wouldn't say that you completely abandon the strategy, but you've got to take a bit of a breather and do some proper analysis. And like I say, you think about how many trades were actually good versus how many were shit trades, and you tend to find that with a lot of people, they take handfuls of crap trades. I worked with a guy recently that said he was trading my strategy. I went through his trades with a fine tooth comb, and I kid you not, he had 4 out of 22 trades that were my strategy. And that doesn't necessarily mean the others weren't good, but every single trade I asked him about, he was like, oh yeah, that was shit. Yeah, I didn't think about this, I didn't think about that. Yeah, I didn't mean to do that. And that's the same for a lot of people. So look at how many do you think were actually good, well thought out trades that fit your plan. Again, you have to look at how many trades have you actually missed. You can't come in with rose-tinted spectacles and say, oh yeah, I would have gone balls deep long down at the low of day and sold the high of day. Again, you have to look at it and think, well, was that a trade I'd have actually done? But we do miss trades, and sometimes they can make a massive difference. Even missing a few trades over the short term can make a huge difference to your edge. You have to be aware of that. And you'd also ask yourself, what is linking your losers? It might be that there's something specific that links them, and we'll talk about all this in a minute again when we get to journaling. So for you, it might be a different figure. If you're risking 0.5%, it might be 20R, 10% drawdown. I'm just telling you what it is for me. The final thing I talk about when it comes to risk is risk allocation. And this is really, really important. Not everybody does it, and in fact, most educators and traders I know don't even mention it. But what risk allocation is let's say that when we're trading, it's possible to break down what we do into different setups. So what I mean by that is, let's say the month-end trade, we'll call that one type of setup. And an open gap with a swing failure, we'll call that another type of setup. So we could have a lot of different setups, and we could be recording them in our journal. But let's simplify it for a minute and assume that we've just got 2 straightforward setups, okay, that we trade on a daily basis. Let's say that we've got setup A, which has 50% strike rate and makes 2R. And let's say we've got setup B, which is going to be an amazing strategy. It's got a 75% strike rate and it returns 3R. Okay, now assume that you've logged them and you've got a decent sample size, over 100 for each of strategy A and B. It should be perfectly clear that setup B is massively outperforming and setup B is the better strategy. So to my mind, it makes absolutely no sense to trade the same size risk across both of them. So, you know, in this kind of scenario, not only are you going to have a better expectancy with setup B, but you're going to get less losers in a row. It's going to make more money. So I would play with the risk. I would bet a little bit higher on those trades. So in the beginning, when I said to you it's 0.5%, that's as a standard amount when you're starting out. You will probably find that you can allocate different amounts to different setups. I believe that I've shared a lot with you in this course, but my risk allocation is the only thing that I don't really want to share with you for 2 reasons. Firstly, it's because risk is really down to the individual, and although some of you will vehemently deny it, I'm aware that if I give my risk levels for certain setups, people will just copy them, and I don't want you guys to play with risk just based on something I say that's unique to me. And secondly, I think it will make people somewhat lazy. You know, I've taught a lot of people, and the more I give them, the less work they do. I have found that out for myself. I was helping one guy go through his trades once, and I spent an entire weekend on it, and he came back to me and said, I'm so glad you did that for me, because it saves me having to do it myself. And I thought, you lazy bastard, you're never going to get anywhere. So I'm not saying you guys were like that, but I would rather not give my ideas about risk allocation. Having said that, if you do the groundwork yourself and you come back to me and you say, Tom, of what you've taught me, I find this works better than that. How do you feel about it? I'll be happy to discuss it with you and give you those metrics. I just don't want to put it all out there and make it too easy. And it's the only thing that, like I say, I'm going to just hold a little bit back on. But I will tell you that one of my favourite tips for growing a small account is to do exactly that. Go through the different strategies that you trade and work out the strike rate and the payoff. And basically what you then want to do is you want to work out which strategy is likely to have the least drawdown, which you can work out pretty easily, and then basically just trade that at higher risk going forward. It's a bit of a controversial point, but I genuinely believe that's the best way to build an account if you're starting with a small account, and that's how I built my record to get into prop. People say, how were you confident enough when you started risking nearly 10% a trade, which is quite frankly fucking dangerous and rather irresponsible. The only reason I did it is because I spent about 3 months going through everything that I did and working out which was the strategy that had the highest strike rate. And I thought, you know what, that strike rate might change over time, but ultimately what I'm going to do is I'm just going to hammer just that and try and get this account off the ground. And as the account gets off the ground, I can of course immediately begin lowering my risk and start to incorporate more of the strategies that have positive expectancies but are probably going to lead to more drawdown. Because with these two strategies we can see, just bringing our probability matrix back on the screen, if you've got strategy B here and it's got a 75% strike rate, your chance of getting 5 losers in a row, it's under 5%. You've got very little chance, over a 50 trade sample size. But if you've got a 50% strike rate, your chance of getting 5 losers in a row is 77%. Basically, it's going to happen. But both of those strategies make money. It's just that A is more dangerous if you're betting larger with a small account. So that's how I see it. So it's not hard to do. If you've got different strategies, you just work it out. And it's something that I think will help you if you're trying to grow a small account. Let's move off risk. The next thing I want to talk about is routine, how I organize myself on a given day. Okay, everybody's going to be different when it comes to routine. I'll tell you how I structure mine. It does change over time. So how I do this now might not be exactly the same as I'm doing it in 6 months, and probably if you've heard me talk about this before, it maybe is a little bit different to how I was doing it then. But essentially I get in at 6 a.m. It hasn't opened. Most of the markets may have moved overnight, but they're quite quiet at 6 a.m. I'm looking at the overnight fundamental news, what the major markets have done overnight. And usually I'm going to be listening to Talking FX and then going on Twitter and looking at what people are saying, checking the calendar for key event risk that day, what's the market waiting for, and then making sure all my levels are drawn for the day. So I know in the Bund, do we have a daily bias? Are we looking for longs or shorts today? Where are the key levels on the profile? Where are the key levels on the 5-minute chart? You need to know this before the market open. If you don't know this before the market open, then it can be a real problem. It might not be for you, but it used to be for me. Now, this is not a great image, but you can download this from my website under the educational section. It's in the little toolkit. I fill this in every morning, and what you're basically doing here is you're filling in the fundamentals, and then we've got our technicals, the levels I want to buy and the levels I want to sell. Really important, so I know what am I planning to do. Write it down, commit to it. Then we write down expectations for the day. Maybe it's a Monday, lack of clear news flow, wide-ranging day on Friday. I'm thinking that Monday will be a low range, low volatility day, not expecting much. Maybe there's key levels to sell above market and fade any movement. Then at the end of the day, when I get to my review, what actually happened in the day, this is where I'm looking to write down things like, for example, maybe I thought, well, I came in at the beginning of the day and thought we were going to be a low range day, but somehow in the middle of the day we popped our head above resistance. I interpreted that as bullish and steamed in long and did my arse. And I can look back and say, well, what got me long when my plan was to fade breakouts, not go with them? And I can start to try and come to some conclusions. Again, learn something. And this is the most important box. What have I fucking learned today? So I really like to use that. So at 7 a.m. Eurex opens, Bund and DAX start moving, and off we go. I usually spend about 3 hours watching the markets quite carefully, and then around about 10 a.m. because it gets quieter, I take a break to re-energize. Usually just go for a walk, grab a coffee, get away from the trading desk. The reason this changes sometimes is that there will be those times when the Bund has done nothing all morning, but it just so happens around about 10 a.m. it's coming into a level. I'll take that trade if I have to. I don't like trading at that time, and I like to be able to step away from the desk and re-energize. I believe it's really important to your focus, but it's the market, it's your boss. You can't control when it's going to tell you to work. But in an ideal day, this is what it will look like. We'll get trades between 7 till 10. We'll take a break at 10. Around about 11 to 12 every day, I try to put an hour aside to do some statistics. Now, what I mean by statistics is basically trying to spend some time on something that improves my edge. And we will talk about this a little bit later, but usually it's going to be testing a proposition of some sort. For example, when I was interested in exploring the Open Drive and how well it worked, the way I worked it all out is spending an hour a day crunching the numbers and going back and counting occurrences of things. It might take you a week of spending an hour a day. It might even take you longer, but it's just a little thing that I like to work on every day, because at the end of the day I like to look back and say, what did I actually do today? I like to have done something useful that goes beyond I made money or I lost money. Have I expanded on my knowledge of this market? And if I can answer that in the positive, which most days I can, then the day has been worthwhile. Then around about 12, I go grab lunch. And I always go out for lunch. I do this to kind of help break the day up. Sometimes I go for a run or a cycle. But I want to say something here which I think is quite important, which is that the time that I spend out at this period here depends on how my day is going. If I'm having a shit day, I stay out for longer. I might meet my mum, for example, and have a long lunch or whatever. But this is really important because it serves the dual purpose of alleviating my stress because I'm away from my PC, and stops me from making potentially shit decisions. When the market's not conducive to trading or I'm not on my A game, my primary focus is to notice it as quick as possible and get away. And going back to what I said earlier, bad days usually get worse. If I've done my arse in the morning, it's quite rare that I'm going to come in and get back to even, or even end up on the day up. Now I'll do it because I believe that you're learning something even watching the market, and there could be a really good opportunity, providing you haven't hit your day stop. You don't want to say, right, that's it, I'm not trading for the afternoon because the morning was so bad, and then you miss something key. You want to be around, but I'm definitely going to stay away a little bit longer, just to feel like I've really recharged, because it takes it out of you when you lose. Especially if you get your ass kicked, you lose 2 or 3 trades early on. And part of that is also how you lose as well. Let's say you're long, you get stopped out for a 10-tick loss, and the market drops another 50, fine. If you're long and you've got a really bullish bias, the market stops you out for a 10-tick loss and then rallies 100, it's a lot worse. It shouldn't be, but it is. So I might stay out a little bit longer than 1, but on an average day I'll get back for 1. I'll trade the US session. 5 p.m. I finish trading Bund for the day. Now on days like FOMC, again, that's going to be out the window. I'll be trading it right to the close. But most days, finish trading Bund around 5, and then I do my Bund review, add all my trades to my journal. Nowadays I'm diligently making sure I screenshot Xtrader because AMP lost today's P&L. And also the other reason you should do that is because, as you probably worked out already, most statements don't give you the times of your trades. I know AMPs don't, so you've got no idea when it gets to your journal what time you got in or out, and it's a bit of a problem. So I like to basically screenshot everything at an absolute minimum. Most times put the trades in my journal so it's done, so that I don't get to the end of the week and I've got shitloads to do. This point I have a break and do something entirely different, and then around about 9 p.m. I just come back and check my daily closes. This is specific to the Bund. It looks a little bit busier than this, because I'm trading 2 strategies as well, but again I've tried to keep it solely focused on the Bund here. During this post-market Bund review, not just filling in the trades but thinking, what did I do well today? What did I do that was not so good? And one of the things that I'm doing at this point is using this fantastic little tool, the Demon Finder. you can create your own in Excel. I can actually send you the Excel sheet if you want, so it's easy to mock up. You just change these things here for whatever your problems are, but these are the common ones. But you want to see at a glance, without needing to refer to some complex journal, where are you getting fucked? Where are your problems? There'll be people here that are coming in every day and saying wrong position size. So learn from it. You don't need to tick all the way up to number 10. What is outpacing the others? Maybe you don't have any problems choosing poor risk reward trades. Maybe you're always looking for 3-to-1 Rs, fine. But you're always doing the wrong position size. 1 minute you're doing 2% of your account, the next minute you're doing 5% of your account based on gut instinct, and it's causing you to fluctuate in your P&L all over the place. It's a mistake, you come in, you try to fix it. Incidentally, I think probably the biggest mistakes that I see here are exiting too soon. People have a real problem with exiting, along with didn't take the planned trade. These must be the two most popular sins. I haven't done statistics on this, but based on what I hear. So again, those are maybe points that you want to work on. But I think the Demon Finder is absolutely essential. So just going back to my daily schedule, that's what the daily schedule looks like. I have a weekly schedule. Saturday I always hold a weekly review. I usually hold one for my swing strategy and my short term, but again, just want to recap on the week. What was the week like for me? And then I hold quarterly reviews where I go through my entire journal, because I don't go through my journal on a daily or weekly basis. I just fill the trades in the journal and try and jot down observations on my behavior. Again, using that daily plan, what did I do well, what did I do badly? But the journal I only really look at every quarter, 4 times a year. And that's when I go through it with a fine-tooth comb and really try to increase my performance. So what we are going to get onto now is journaling. And it is, I think, the most important thing to do in terms of your performance. I'm not going to get out my journal because, again, it doesn't matter about what I have done. You're not going to be a carbon copy of me. However, you do want to get a pen here, because these are certain things that you can do to increase your performance massively. Now, I use Edgewonk. I'm sure everybody knows that. And Edgewonk's pretty good. I haven't moved to 2.0 yet. Probably should have done, but I haven't. So I'm still using the old one, but if you've got 2.0, I would strongly advocate using it. I think this is a fantastic tool. I really do. I'll bring it on the screen now for those that have never seen anything like this. But basically, what you'll see is an incredible journal here. It takes some time to learn, it takes some time to fill it in, but it has everything. So based on your trades, it will give you your win rates overall, running weekly stats, it will give you an equity curve. Here is the journal page where you fill in everything, and again they have numerous videos on how to do this. And then you've got your trade analytics. I won't go through this now because you can look on their site, but I tell you what, Edgewonk will do fucking everything for you but make you a cup of tea. I mean, it's unbelievable. The downside of it is it takes ages to get to grips with. But I will be honest with you guys, you don't need to buy Edgewonk. I mean, it's good, and I think you'll do well if you buy it, but you don't need to. For years, I used a very, very basic journal, and I'm going to pull it up on the screen. I won't go through it in too much detail, but again, if you want a copy of this, I'm happy to actually send you this. When it comes to the trade details here, the date, the day, the time that you took the trade, the market, obviously again in terms of what we're talking about tonight, it's all going to be Bund. The setup, if you trade different setups, whether you went long or short. Time frame may be redundant because for me it's always the same time frame. Then you've got your entry details, so the size you did, the risk of account, entry price, stop loss, where you put it in terms of the price, how much tick stop loss that is, your target level and your target in ticks. And then we move over and we're looking to record whether the target was hit or the stop loss was hit, actual exit price, actual exit again in terms of pips, ticks, whether it was a win or loss, and the profit. All right, and then your account equity updates, your result in R. This is the really important bit that we'll talk about in a bit. Maximum adverse excursion and maximum favourable excursion. The maximum favourable excursion we'll start out with, which is basically, regardless of where you come out, how far they go before they hit your original stop. So let's say that you take a trade and you have a 10 pip stop and it makes 10 pips, right? So you get out, you've made a 1R, but it might be the case that that trade goes 150 pips before it eventually comes back to hit your stop. You've only captured 10 of a possible 150, but your maximum favourable excursion would be 150. This is something I do take note of. It's quite difficult to do though, because you have to keep track of a lot of trades at the same time. That takes some work. This is a lot easier, the maximum adverse excursion. So what you do on the maximum adverse excursion is just on your winning trades, you're going to note how far they went against you. So let's say you got a 20 pip stop, 50 pip target, it hits your 50 pips, and you look at how far did it go before you got your winner. Maybe it only went 7 against you towards your 20 tick stop. Maybe it went nothing against you and you bought the exact low. But that's what you note down there. Over time, the reason we're obviously doing that is to see whether we need such a wide stop. Again, something I'm going to dwell on in a minute. Then the trade length, quite interesting. You might think to yourself, well, who fucking cares how long your average trade is? But I think you would need to know things like this, because a newbie would ask, I've been in this trade for 2 hours. Now what? Do I cut it? It hasn't gone anywhere. If you don't know these things, you've got no idea. You're totally shooting in the dark. So again, with my Boon strategy, I'll fill in these things. If I'm trading a 5-minute level, did I have any of these confluences? Daily bias? Was there a weekly profile level, a daily profile level? Was there hourly price action, bearish engulfing, bullish engulfing, something like that? For the medium term, directional bias. Maybe we were at ATR. Was there fibs? Was there pivot points? Were we at the VWAP? Was there order flow? Okay, I'm brushing over these things very quickly, but again, as you look at the recording, you'll be able to pause it and go through it in your own time. You can always ask me anything, but it should be fairly straightforward. I'll try and see if there's something that links your winners. Maybe your winners just happen to be when you tick a whole lot of these. So on this particular trade, what happened here, what happened after? I always like this column again, because it's usually where you learn the most. What happened after the trade, when I got out of it? Is there any lessons that I can have learned? And that's your basic journal. It will cost you nothing because I can send it to you. And you might come up with other things that you want to put in there. Keep it simple, but then as you add columns and track different things, it will get more complex. It doesn't matter whether you've been trading 20 years or you placed your first ever trade 3 minutes ago. You never stop learning. And we need to learn from our journal certain things. And the fact of the matter is that most people do not try to learn these things every day. But I will explain what these things are. These are the things that we are looking to learn. How can you make more money from your winners? How can you lose less money from your losers? How can you generate more winning ideas? If you can work on those 3 things, your performance is going to increase massively. They're directly related to your edge. The first one is giving you a higher payoff ratio. The second one is also working on your payoff ratio because your losses decrease in terms of your average loss versus average win. And the third is giving you a higher number of trades and even potentially a higher strike rate. So they are simple, but they're important things to work on. And to put it another way, what are you doing this month, this week, today, better than you did last month or last week or yesterday? So these questions are really never leaving my mind. Again, it comes back to improvement. Think about your winners, think about your losers, think about your general ideas for the markets. Is there a way to capitalize on different ideas that you get through testing them? So the vital thing to realize is that although you might record all your trades, it's no good just recording them and storing it somewhere. You have to analyze them. That's absolutely key. I know a lot of people that spend all their time writing down their trades in a book or in a blog, and they never bloody review them, right? They might be able to tell you, oh, this is what my equity curve looks like, or I'm doing well at the moment, or I'm doing shit. But that's about as far as they take it. So if you've got a record and don't look at it, at least quarterly. You might as well not have one. It's not a list of your trades to stick in a folder and fucking read back on like a diary once every 3 years. It's there literally to make you a better trader. So we improve on what we're doing to get better results than our peers, and we discover new patterns that we've not been taught. That's what the journal does for us. So now let's look at some of these points and talk about them in some detail here. Firstly, how can I make more money from my winners? Well, one of the things that you want to look at straight away is, are you getting out of your winners too early? So start by looking at your recorded trades and looking at where your original target was, and compare this to where your exit was. So if you see a lot of trades where you say, I had a 50 tick target but I came out for 10 ticks, then you've registered that you've come out before your target. What you need to do is go over your history and see what would have been the net result if you didn't touch the trade at all and simply left it to stop or target. Now, this is not very easy to do if you don't have targets or stops at the trade outset, but the question is of utmost importance, because I have found this is such an easy win with a lot of traders. You can improve your performance massively in the time it takes to check over this, which isn't that long. If your record clearly shows that over the long run you're fucking things up by managing your trades, you've literally just found your own personal holy grail. Because if you're not managing trades, you're getting a better return for less work, if you find that that works for you. So you want to run this over at least 30 trades, 3 months. We measure this in Prop. We get a 22-page report on our performance at the end of every month, and this is one of the key metrics that they look at. So how much of the opportunity did you capture? Because nobody wants to see a trader that keeps calling 100 tick moves and taking 10 fucking ticks. Why are you doing that? Now, let's look at a couple of examples very quickly, because in the short term, that is naturally going to happen from your strategy. I'll show you a couple of examples from my own trading. Let's go back on the Bund right now to the 24th of this month. Be interesting to see if any of you guys got this. So there was a cracking level on the 24th, and it was at 164.30ish. And you can see that we form support on Monday the 24th of October, and we break down through it, and you can see that this area here is the last low pre-breakdown. Stop goes up here. Nice and simple. This is like a trader fucking Dante special, okay? I sold 34s, stop above the thrust at 41s, it was a 7-tick stop, playing for 12s, which is this low, right where support is. Now if that breaks, again, what you're going to do, come in and sell the retest of it, but forget about that for now. This trade number 1 is an obvious trade. If you didn't take this trade, why not? What were you doing? But anyway, we've got a 7-tick stop, we're playing for 12s. Now I got out of this trade on the close of this candle here. So I actually exited at 16s rather than 12s. Why did I exit on the close of that candle? Because I was trailing my stop, and this was the thrust candle here. We broke down through this little interim low, that little interim low, and we stopped right on that low. And I thought to myself, well, I can move my stop to above that thrust candle, but then the evolving R is not particularly good. So I got out of the trade, and it meant that I captured 18 ticks, which is, you know, not too bad at all when I only risked 7. But I captured 18 ticks. But the fact is, in the journal, I'm going to put the target was hit for plus 22. In terms of the metric, I captured 82% of the opportunity. I captured 18 out of 22. Now later on, we had a bearish engulfing. Once that day formed, we get this bad boy here, which, if there's ever in your entire trading career in Bund a better opportunity to go balls deep short than this, I don't know what it is. Bearish engulfing after faking out the high end of the range, and we've got a really solid inflection point here. Previous support, flip to resistance, we break down through it, come up from below, get a bearish engulfing. But let's go over what happened here, and I actually want to talk about what happened with a student on this trade. But they come in the next day and they sell 13s. Now 13s is there. Okay, so you've got a bearish engulfing. You're looking at levels to sell. Here's the last untested level. Okay, see that it's naked. We didn't quite test it in that region there. So there's a naked level at 13s. I actually did sell 13s as well, but I'm talking about what they did now. So they sell 13s with a 4-tick stop above this high. Now I think that stop was a little bit tight, personally, because it was right into this little low. I would have put it a little bit wider, but again, forget about that for now. They traded it with a 4-tick stop, and it never got hit, that 4-tick stop. The market put in these 4 highs over 20 minutes just before their stop. Now their target was on an hourly chart all the way down here. I'm just going to pull it up so you can see. So they're getting in here after the bearish engulfing is formed on the daily, and they were looking for a big move. Now they weren't quite looking for the Brexit gap to fill, but they were looking for the first area of prior resistance underneath the range lows. Where I'm drawing this magenta line is the range lows, and they were looking here. So it's tiny little inflection point, resistance, support, resistance. And in a nutshell, their profit target was 187 ticks. Right, now get this, they're risking fucking 4 ticks to make 187. That's a 47R. That's insane. How many ticks do you think they got out of that move? Well, I'll tell you, they got 21 ticks. Now again, not a bad return. They got short here, the market starts selling off. When it broke these lows here, they trailed their stop above the thrust candle. It's the kind of thing I've taught, and that's absolutely fine. It's another winning trade. They caught 21 ticks. But 21 out of 187 is only 11% of the opportunity. You're going to journal that, and you're going to find over 2 trades that, since that never hit the original stop on either trade, doing nothing made a massive difference. I mean, we are talking an insane difference through just doing nothing. Is it easy to do nothing? Is it easy to be this on side and then potentially end up giving it all back? Hell no, of course it's not. But if you have stats to prove it's the right thing to do over time, then you would do it. This is one of those potential problems where people always, I find, blame their psychology. Okay, so when they get out early, they always say things like, oh man, I'm so psychologically screwed up, I just keep coming out my trades early. No, you're not fucking psychologically screwed up at all. And you don't need a psychologist or any bullshit psychology book. The reason you came out early is because you do not categorically know over a large sample size that holding is the right thing to do. That's simple. I don't believe anyone in here is that much of a cunt, that, excuse my French, that they would look at their stats and go, oh yeah, over a huge sample size, the right thing to do is hold, but I'm just not going to hold. People aren't, that's dense. They do it because they don't have the stats. I genuinely believe that, and maybe I'm being too optimistic about people, but that's what I believe. So if you don't know your stats, how can you be expected to hold? But let me save you a bill from your local psychologist and just tell you, record your trades, record them carefully and have a look, at that simple metric. Are you better off just doing nothing? Especially if you're like me and you trade with stops and targets. And of course, if you're finding out that you're leaving a lot on the table, it's one thing knowing it, but it's another thing just thinking about why you might be leaving a lot on the table. Are you leaving a lot on the table because you're just shitting yourself and bottling it? Or are you leaving a lot on the table because you stick to your rules, but your rules are shaking you out? All right, in the 2 examples I showed you there, no one was bottling it. We stuck to the rules. The rules did get us out a little bit early. That was over 2 trades, but how does it look over 102? Now, if you trade without targets, or you find that not doing anything makes little difference, the next thing you can do is you can look at how far your trades go after you come out of your winners. So are you finding that you're picking 50 tick targets, but a lot of the time the market is running for 250? So if you do find that, and believe me, a lot of people do find that quite a few of their trades go way further than they took them, what you can do is go back over your trades and try a variety of different management techniques on them. This incidentally takes ages to do, but it's something that Edgewonk does really well. You can just try a number of different things. So, like for example, I use trailing stops, right? I trail stops behind thrust candles. But you might want to think, okay, on this trade, I got stopped out with my trailing stop behind a thrust candle. But let's have another couple of columns in our Excel sheet, and let's have a look at what would happen if on every trade I trailed my stop behind the last 5-minute swing. Or what about if I used a 10-tick trailing stop fixed? Who knows? Nobody knows what the result would be unless you record it. But you can get really creative with this, and I think it's really fun to do it. I'm sure not everyone would find it fun crunching numbers, but at the end of the day, it's fun making money, and that's how you're going to make it. The quickest fix you can get when it comes to journaling, that every single person in this room should do as soon as they're out of this bloody webinar, is look at your maximum adverse excursion. How far do your winners go offside? Right? I was talking with a great trader not that long ago that told me his winning trades never went more than 10 ticks offside. So for his entry criteria, it had become evident that if he suffered more than a 10-tick drawdown, something was wrong and the trade should be cut. But the interesting thing is that he usually traded with 30-tick stops. So as soon as he realised that his winning trades didn't go more than 10 ticks offside, he immediately brought his stop down from 30 to a fixed stop of 10. His R's just trebled, and he's making a lot more money. It's such an easy fix. You can't believe how easy that is to do. To just go back through your trades, look at your maximum adverse excursion on your winners. How far did they go against you? Because a lot of people, they have like 100-tick stops. I'm more talking about the swing strategy now. But people have 100-tick stops, and it's not necessary. You want to get that stop as tight as you can, and this is one way to work it out, how tight you can do it. So another thing to think about is, let's assume something quite insane. Let's say that you use a 50-tick stop and every single one of those trades went against you by like 45 ticks. So you can't really tighten your stop. They all eventually reversed and 100% of your trades win. Right? Not going to happen, but let's just assume it. You didn't take a single loser over a massive sample size. You got 100% strike rate, 50-tick stop. Everyone went against you by 45 ticks. Okay, you can't really tighten your stop any more than that, so you need a 50-tick stop. So what have we learned from this? What we've learned is that your entry is obviously dog shit. If the market's going 45 ticks against you, but you're getting a winner every time, great. Fucking enter as close as possible to where your stop is. Have a look what links your trades. This is again improvement. One thing I spent a lot of time doing, and I mean a lot of time, is studying the different areas that price went to, and that's how I found out about the last high pre-breakout. You know, we get an area and the market breaks out of it. I used to always buy it here at the high end of the range. And I studied my trades for a long time, and I noticed that one thing that linked the winners was this. Basically, I'd look at them and I'd see this kind of pattern, and I thought, shit, you know what? The market's coming down to that last little high. Now, obviously, again, I'm simplifying it here. It's not going to be every single trade. It's usually not going to leap out and smash you in the face, that obviously. It takes some time. But this is part of the puzzle, and you work to try and find out these things. One point to note is that you might think, well, my mentor will tell me this, if they've done the work. You guys are lucky that I've done quite a lot of the work, but I'm always learning things. When I'm going through my journal in future, I'm not going to be emailing you every 5 minutes going, hey guys, look what I just learned. So you'll want to do this work yourself as well. So that's why it's quite important to save screenshots of the charts after each trade, so you can see things that link trades. So the next thing we want to work on, how can I lose less money from my losers? You look for something that links them, quite frankly. Price action is a good place to start. If you buy a level like this, what happens if we close down through it on the 5-minute time frame? Do these instances lead to the trade hitting your stop or not? Again, something to start thinking about. I found it doesn't, but I'm putting it out there. What about time of day? Are the vast majority of your losers taken at a certain time of day? I haven't found that in my trading, interestingly enough, in the Bund, but you might. What about day of the week? Okay, are there certain days of the week that cause you problems? I hear so many people, right, say that Fridays are shit, but I found that to be a real red herring. I can tell you from my stats that Tuesday and Friday are my best days now so far over 2016, and my worst day for trading Bund is a Wednesday. Now again, I didn't want to get too much into my stats because these stats are meaningless. They might be completely different to you, and that's why I don't want you to get too hung up in it. I don't want anyone going out of here thinking, fucking hell, Dante said Wednesday's a nightmare day, I'm going to take it off. But I want to just tell you a lot about my own trading, but mainly the important thing to learn is what you need to look at. Another thing when it comes to difficult periods, July, consistently poor for me over the years, and I've seen that echoed among many other professionals. So have a look at your journal. You know, are there certain days? Are there certain periods? What about the number of trades you take on a day? Does that link your losers? Are there any particular markets that you don't perform well in? Okay, it's all about losing less money from your losers here. Is there anything that you shouldn't be doing? I used to know a guy that couldn't trade the DAX. This was hilarious. I've told this story so many times. This guy did his ass from morning till night in the DAX, but every time he touched the Bund, he made money. What do you think the guy should do? Let me think about this. He should trade the Bund and leave the DAX. No, instead, the silly bastard said, oh, I'm actually going to trade the DAX even harder because it's such a great market. The Bund's so boring, it moves so slowly. So he steamrolled into the DAX, spent all his time on it. 18 months later, he had no job. I kid you not. Some markets you are better at than others. Just keep an eye on it. I'll make you laugh now. This is my performance the last month gone across rates and cash FX. So I've made over $20,000 trading the Bund, but I've lost money trading the Forex. Now it's only a month, right? But look at that over a year, you might find something fucking interesting, like certain markets you should not be touching with a barge pole. This is incidentally part of the massive PDF that these guys send me at the end of every month. So maybe it's something that links your losers is something that you picked up in the Demon Planner that I showed you earlier. You know, you're taking loads of trades that don't fit your rules. But this is basically what you want to work on. I talked to you about strategy allocation. Keep an eye on your strategies. Are there certain things that are not performing well? Are certain strategies look like they are losing money and not working as well as they used to? It's going to happen from time to time. You've got to stay on top of it. One thing I should note here is that when you analyze your losers, you also have to look at your winners, right? That should be obvious, but you've got to make sure that you don't see something in your losers and think, oh, right, okay, fine, I won't do that anymore. But it's also present in your winners and vice versa. But all you're trying to do is isolate an issue and fix it. And by the way, this does take time. Okay, there are periods where I can think of an idea and think, you know what, I want to test out a feeling I've got that maybe, I don't know, I trade really badly on NFP day. I might not be recording that in my journal. So I got to go back and source the date of every NFP day, go back through my journal and source what I did on that day, what my P&L was like. It might take me a weekend to get enough stats to find that out. And I've done this before. I've spent an entire weekend testing out an observation only to find that there's nothing actionable that I can use at the end of it. So finally, we get on to this point here. How can I generate more winning ideas? Simple. Test every observation that you think about. Month ends, right? I started testing month ends with a fine tooth comb. Why? Because quite a lot of people that I was working with said they always traded it. The open drive, you know, there I am reading Dalton's book Mind Over Markets. I think to myself, well, I'm going to test that observation. You know, that takes a lot of time, but it's quite important to go through and do that. The other thing to think about when it comes to generating more winning ideas is how many trades do you miss? This is quite interesting because I know we always do that hypothetical, I would have done this, I would have done that. But seriously, how many trades do you miss? I miss a shitload, and I'm sitting here all day. I know some of you are thinking you're on Twitter all day. but I do miss quite a lot of trades. And you know, you have to obviously be fair and count the losers that you miss alongside the winners. But it's interesting, and if you miss trades, why are you missing them? Are you missing them because you didn't concentrate? Or are you missing them because, you know, you stepped away from your desk? Are you missing them because you second guessed yourself? So those were the things that I wanted to, you know, talk about when it comes to journaling. Again, how can I make more money from my winners? You know, test out active management via hands-off approach. Very simple to do. What happens if you don't touch your trades? Do you make more money? Are you getting out too early? How long are things running for? Is there a better way to actively manage? Check your maximum adverse excursion. Probably this should be on the list at the top, if I'm honest, because it's the quickest win that you can get, because your payoff can increase dramatically if you sort this out. And think about your risk allocation. Are you risking the same amount on every strategy if some strategies are really outperforming? Here's the bullet points again for how can you lose less money. Is there something that links your losers? Price action. Look at your screenshots of trades. Time of day, day a week. Certain markets you're shit in. Are you sticking to your original plan? Is the strategy just flawed? You know, things to think about. And how can I generate more winning ideas? Look for patterns in your losers. Sometimes losers can be turned around to create winning trade ideas. Let's give you one more story, which I've told so many times, which is how I discovered the swing failure. The way I discovered the swing failure is a student I taught one-to-one mentoring called Jeff. And Jeff was basically asking me to review his trades, and I had not discovered the swing failure at the time. I was predominantly trading levels. And one day Jeff asked me to go through all his trades, and what Jeff was doing was he was basically buying in a situation like this. The market is in a trend, right? And he's buying it up through the high, so it's a trend continuation trade. Nice and simple. I was looking at what linked his losers, and you've got to be honest, I didn't notice this straight away, but after looking at all the screenshots of his trades and giving it a day and mulling it over and coming back and trying different things, what I realised is that if it closed through that high was of fundamental importance. And I noticed that what linked so many of his losers were when he buys it, it fails to close through the high and immediately it would hit his stop. Whereas if it closed through the high, it didn't mean it won every time, but it had a lot higher probability of keeping going. And he traded this on a, I think it was 4-hourly chart. So if it closed through a swing high on a 4-hourly, it had a lot greater chance of going. And so seeing that he was getting stopped out, I suddenly thought, holy shit, there's a pattern here. If it fails to close through the high, it's going to pull back. And it probably sounds so simple to you guys. You're probably thinking, yeah, no shit, Sherlock. But I hadn't thought of this at the time. And I got the SFP from somebody else's journal. Simple as that. Just turning a losing proposition on its head. And today it's a pattern that I've made countless thousands from that pattern, from fucking doing somebody else's journal for them. I wasn't taught it, you know. I know it's a pattern that's out there. I didn't invent it, but, you know, I found it for myself. Honest truth. So that is my conclusions on trade journaling. If you get things that you think about when you're journaling, you get things you want to talk about, by all means contact me. I could talk about journaling until the cows come home. Alright, ledges, so 2 more lessons in this course. Next week I am going to give you some exercises, some of them really fun, for ways that you can improve your tape reading skills and your general trading skills. And we'll go from there. If you do get any questions at all, if you want any help with journaling, just drop me an email. If you get any points that you thought about tonight, let me know as well. Alright guys, so I will catch you next week, and please do try to do some of those things that I spoke about. I know it's not the most exciting, but please try to do it, because you will improve. You will improve drastically. Alright ledges, speak soon.